What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome to another episode of the CPA Zone. Today, we're going to dive into a strategy that real estate investors tend to use when they have a partnership or an LLC with partners and members that can't agree on exit strategy. And what we're talking about here is something called a drop-in swap. So it's a way that allows some partners or members to defer taxes using a 1031 exchange, while others are able to cash out and leave. So it sounds simple, but there's a lot to it. So let's unpack it. And you'll notice I use the words partnership and LLC interchangeably. That's because LLCs with more than one member are treated as partnerships for tax purposes. There is a technical difference, but not really important for today's discussion. Now, as a refresher, let's just start with what is a 1031 exchange? As most of you probably know, 1031 exchange allows you to defer your capital gains and depreciation recapture when you sell a business or investment piece of real estate and reinvest that into another business or investment piece of real estate. But here's the twist when it comes to the drop-in swap. It has to be the same taxpayer that sells and buys the properties. So technically we're doing an exchange, but has to be the same taxpayer. So as a reminder, to successfully complete a 1031 exchange, you have to, one, use a qualified intermediary. You also need to identify your replacement property within 45 days of closing on the sale of your original property. You also have 180 calendar days to complete the entire transaction. And as we already mentioned, the exchange has to be an exchange of business or investment real estate for other business or investment real estate, not personal real estate, not real estate that is treated as inventory, such as fix and flips. It has to be used in a trade or business or held for investment. And the key here, the same taxpayer who sells must buy. So that's pretty straightforward, being the same taxpayer that sells and buys when you have one owner. But what happens when a property is owned by multiple people through a partnership or LLC structure? And not everyone wants to 1031 exchange. So that's where today's topic, the drop and swap strategy, comes in. So the strategy in a nutshell, because LLC interests or partnership interests cannot be swapped under the 1031 rules, investors got creative and developed the drop and swap strategy. So in the IRS code, in regulations, swapping LLC interests or partnership interests is specifically excluded, so that you cannot exchange a partnership or LLC interest. The drop and swap is a workaround that allows some partners to defer taxes using the 1031 while others cash out. So before the sale, the partnership will deed or drop the property to the individual partners as a tenant in common, so a TIC structure. Now each partner owns a direct piece of the real estate. So now they can use the 1031 exchange. And after that, each partner will decide, are they going to do a 1031 exchange or will they take the cash and pay the taxes? So everyone kind of gets to choose their own path. So step by step, how this works is step one, we have the drop. So first, the partnership or LLC will distribute the property to the individual partners as tenants in common or TIC owners. So the deed should reflect this. Now each partner owns a direct fractional interest of the real estate. So you can 1031 exchange because now you're with real estate to real estate. Ideally, this drop's going to happen well in advance before the sale. So before the property even goes on market. The second step is going to be the sale. Well, some swap or some cash out. So now that the property is sold or exchanged, at closing, each tenant in common owner gets to decide, am I going to reinvest my proceeds into another deal using a 1031 exchange, or do I want to cash out and just simply pay the tax? Next step, step 3, would be find the replacement property and acquire it for those partners that decide to stay in and complete a 1031 exchange. So those investors that choose this route will reinvest the proceeds with the same ownership into a new property or properties. While those cashing out, again, they'll pay taxes on their gains and go their separate way. And then next, after the deal, so after the sale or exchange occurs, the original LLC is typically dissolved. Maybe it continues with fewer members. And then the co-owners of the new property after the exchange, they should make sure their TIC ownership is structured properly to ensure it is compliant. So this all needs to happen upfront. So really that TIC ownership needs to be carefully examined when it is received and distributed in step 1. And when they go into the new property, they're typically going to 1031 exchange their interest in this tenancy and common structure into some new ownership. Maybe they do their own 1031 exchange. Maybe several of them go together and get a new property. They're still going to be in this TIC structure, and it needs to be set up appropriately to meet all the IRS rules for the 1031 exchange to pass the test. So let's look at a quick example of how this would work. So let's say ABC LLC owns an apartment building. So we have Alice, Bob, and Carol, all partners. So Alice and Bob, they want to reinvest in 1031 exchange into a new property. Carol wants to exit. She just wants to cash out. So the LLC distributes the property, breaking it into thirds, so 1/3 each. And they dissolve the ABC LLC. Now later they're going to sell the building. It's called $3 million. Alice and Bob each direct their $1 million into a 1031 exchange. Carol takes her $1 million and pays her taxes. So that's a very simplified version of how a successful drop and swap looks, kind of executed to match everyone's goals. There are several court cases out there. Most of them, they're old. They're primarily from the 70s and 80s, but they really helped shape this strategy. There's a court case called Magnuson versus Commissioner, which I believe was in the early 80s, if I'm not mistaken. So in this case, the taxpayer swapped the property and then dropped it into a new partnership. And the court said, no problem. The taxpayer in this case, they were still invested in the real estate. The only thing that changed was the ownership form. So they had a piece of real estate, exchanged it, and then shortly after contributed that new property into a brand new partnership. There's another called Bolker, Bolker versus Commissioner. So the property in this case was dropped out of a corporation through a liquidating distribution and then swapped shortly after. And again, the courts upheld this and allowed it to fly. So, and there was also another Maloney versus Commissioners, pretty much a textbook drop and swap. So the tax court allowed it. And then we do have one Chase versus Commissioner. This is the one to watch out for, where the IRS collapsed the steps and said it was all simply a disguised sale. No 1031 was allowed. So the takeaway from this is you need good facts, good timing, a real investment intent. The IRS, what they'll look for, there's no direct regulations on the drop and swap, but they have put little clues or hints out there. So on your Form 1065, Schedule B, they ask about this. One of the questions asks about, they don't call it drop and swap, but they do ask a question that would indicate that a transaction has occurred like this. Quick drops right before a sale are a red flag. You're really running a risk if you do the drop to a TIC structure just before the sale. And quick sales right after the exchange, also a red flag. So you want to buy, when you exchange into a new property, you have to have that investment intent and hold on to the property. Now, sure, facts can change, maybe you sell, but you should be able to document and back that up. So this strategy does invite some scrutiny by the IRS. So documentation and timing are key. And some risks to keep an eye out for is, make sure, was the property really held for investment intent or used in a trade or business, both the old property and the new? Could the IRS argue it's a step transaction? So a step transaction is one which the intent behind the steps in the transaction are done simply to alter the tax classification. So the IRS can recharacterize a series of steps into a single transaction under the step transaction doctrine, so be careful here. And also are the TIC owners, after the drop happens, are the TIC owners acting like a partnership? That can blow things up as well, because the IRS could come in and reclassify the TICs as a partnership, and now you're exchanging partnership interest for partnership interest. And there are some things you do to protect yourself there. There's an election to make sure you're not taxed like a partnership, and just, again, good documentation, very important here. And could there be other issues, things like mortgage clauses? You're going to have to deal with your lender. They're not always happy to do anything that's not in just their ordinary day-to-day lending. So this is going to be something new for most. Lease assignments. The leases will have to be handled appropriately for the new TIC structures. Operating agreement issues. Make sure the LLC operating agreement doesn't have any clauses that can prohibit something like the drop and swap. These all need to be addressed. The earlier, the better. Otherwise, you run the risk of having the deferral under 1031 disallowed or having to fight it in court. So if the IRS disallows your exchange, then you're looking at the full tax plus penalties and interest if this isn't done right. So just kind of wrap up here, the drop and swap is definitely a legit strategy when done right. It gives the partners some flexibility, and tax deferral is one that's popular among many. Some may want to cash out and go their way. But the drop and swap strategy is not a casual do-it-yourself maneuver. A lot of legal issues to deal with. So plan ahead, get your documentation in order, talk to a tax advisor that understands the strategy. So that about does it for today on the CPA Zone. If you found value in this episode, hit that like and subscribe button and share it with someone in the real estate game. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.